Welcome to our 2017 webinar series. This year's theme is Creative Solutions, Our Concepts, Your Clients. Each month we'll focus on stories of your clients spanning through various generations. We'll explore plans for your professionals starting on their careers, newlyweds and growing families, small business owners, and soon-to-be retirees. We'll show you how we carefully crafted risk management strategies to help your clients enjoy life in the moment. This month, we'll highlight annuities as June is Annuity Awareness Month. Each month's series will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. And since timing is everything, please ask questions as you have them by typing them in. We'll do our best to answer them as they come in. Today's webinar is being recorded and will be posted on our website within a week in case you missed it. And throughout 2017, loyal fans will receive 9 CFP CE credits, 1 for each month. Today's presenter is constantly monitoring the changes in annuities and hybrid insurance and ensures your clients are getting the most up-to-date solutions. He joined LLIS in 2008 and has over 20 years analyzing, studying, and researching annuity solutions. And now to share the different types of annuities, Jerry Skapiak.
Thank you, Claudia. So today we're going to talk about Annuity Awareness Month. Today I've been in the industry for 20 years and hopefully I have a little insight onto how annuities work and how they can help your clients in their retirement. When your clients are entering retirement, they're coming to you. That's probably the #1 reason why clients are approaching you for your services that you offer, is to help them reach that magical moment in their lives when they can retire. For clients, the way they're viewing retirement is that it's going to be like 35 years of unemployment that they're going to have to use their own money they saved for to live on. So it's scary for them. In fact, clients that when they think about retirement, 76% of them are completely stressed out about it. They don't know what they're doing. They don't know if they're saving enough. They're confused. It's the whole topic stresses them out. In fact, a lot of people even avoid even having those conversations. 45% of Americans have saved exactly nothing towards retirement. Now, granted, this is not going to be your clients, but this statistic is astonishing to me. Everybody knows that day is going to come up when they're going to retire or when they're no longer able to work. We can't depend on Social Security being there, but yet they're saving nothing to take care of themselves. Now, this 22% are hopefully the clients that are working with you. 22% of clients feel they have saved enough for retirement. But even these clients are still going to be a little stressed out when they're thinking about retirement. So just always remember that with your clients, that they're more than likely stressed out when they're thinking about entering retirement. So what I want to do today is we're going to talk about ways we can help alleviate some of that stress for your clients. So we're going to talk about income riders on annuities that can provide income to your clients. We're going to look at fixed deferred annuities, immediate annuities, QLACs, which is one of the newest things in the annuity world, and inherited annuities when your clients have inherited an annuity. So let's start by taking a look at income riders on annuities. Here is Nan. Nan is a dear friend of one of the financial advisors. Her daughter died in a tragic accident way too young in life. But her daughter had a life insurance policy, and Nancy was the beneficiary of that life insurance policy. She invested that money wisely over the years, but it was the only money she had. She kept her money separate. Her husband kept his money separate. And as she got older in life, she was afraid of losing that money that she's accumulated and saved and had grown, afraid of losing it due to market turmoil. She didn't need the money right away, but she was definitely going to need it in the future for income. So Nan was working with her friend, her advisor, and they came and talked to me about, this is Nan's concern. What do we have? So we talked about using an annuity with an income rider. It still allows for growth, but that income rider is going to lock in that growth for her on the rider side and guarantee her some income. Today, Nan, she now lives in a retirement home as of last year, and she's taking income off of that annuity. So let's take a look at Nan's annuity. So something I do every single day for advisors is I review annuities your clients have. This is Nan's annuity. This is a typical statement. Statements all look a little bit different, but they all pretty much contain the same information. So what I want to do is just kind of go through Nan's annuity. First up there is her policy number. I don't need to know a policy number on an annuity. I can't do anything with it. The date of issue, very important. It's going to help me calculate when the surrender charges are over or what the surrender charge percent is currently. We have the name of the owner, which in this case happens to be Nan, and then who the annuitant is. Sometimes I do see them where the owner and annuitant are different people. Another important piece of information, whether it's a qualified or non-qualified annuity. Nan's happened to be non-qualified. She did use the proceeds from that life insurance policy to fund it, to fund these investments originally. On this statement, they call it policy type. What I'm basically looking for, I'm looking for what is the marketing name of the annuity. When I'm asked to review an annuity, I gotta have a statement to do it because that statement's going to give me that marketing name, and then I'm able to go through other sources I have and find some of the details out about that annuity. If you send me the actual policy without a statement, I'm going to have to come back to you and request that statement. Policy is not going to tell me the marketing name of the annuity, and I can't look up what I need to see so I can help you with providing advice for your clients. Then we go over to the left side of the statement. It tells us what the policy value was a year ago. In this case, it was $933,000. Contributions, there was no further contributions into this annuity. Nan has started taking withdrawals out of this annuity. So that's what's shown here by withdrawals. Charges, with that charge that we're seeing here, that is the cost for the income rider. Those riders have a fee to them. It is separate. It's not embedded like some of the other fees in the annuity. It is a separate charge and is showing on the statement what that charge is. Gain loss of the annuity. Every statement shows that. And then we have the policy value at the end of the statement period. And this statement happens to show us what the net deposits have been into the annuity. But this is the part everybody always wants to know about, the income rider. Every company has their own marketing name for those riders. A lot of those rider names are trademark, and there are even patents, some of them, on how they're calculated and how they work. But even though they do all that, they all work pretty much the same, maybe some little twists here and there. And in my opinion, it just makes them all that much more complicated, especially for clients to understand. But when we're looking at Nan's annuity here, she has what's called a guaranteed lifetime withdrawal benefit rider. She's taken withdrawal, so it's in the withdrawal phase. But we see right here what her benefit base is. This is the value of the rider. It's different than the account value, or her policy value is $968,000. This rider value is $982,000. So the rider is worth more than the account value. This shows us how much she's able to withdraw each year. In her case, it's $54,000 a year. The last step-up date, we're going to talk about step-ups in a couple of slides. There haven't been any step-ups on this annuity recently. Withdrawals taken during the contract year. So far, she's taken out $9,000 out of this annuity. She's taken no excess withdrawals, and we're going to talk about excess withdrawals and what those do. It tells us when she started taking withdrawals, which was July 1st of 2015, and it shows us what the charge is for this rider, 95 basis points. Some statements show that, some don't. With the sources I go to, I'm usually able to see what all the charges are for the various annuities. So now with income riders, there are two main types of income riders. There's the GMIB and the GLWB. GMIB is the guaranteed minimum income benefit. If you ever see a MetLife or now what's called Bright House annuity statement from your clients, it more than likely has this rider on it, the GMIB. It has two options for your clients to take income. Option one works just like the GLWB or the Guaranteed Lifetime Withdrawal Benefit. It's going to allow the client to withdraw up to 5% of that benefit base for life. Now, something that I want to make clear, a withdrawal and annuitization are two different things. When you're withdrawing money out of an annuity, the value of that annuity, the actual account value of that annuity stays there. You always have access to your account value when you use a withdrawal option on an annuity. The second part of the GMIB is it has an annuitization benefit to it. This is where you're going to turn over that whole account value to the insurance company, and you're going to annuitize that annuity. And by turning over that money, they're going to guarantee you an income stream that's going to be higher than that 5% withdrawal that you get under option one. So it depends on what the client wants. If they want to maximize their income, then they want to choose option two. If they want to maybe hang on to the cash value because maybe they're not sure how long they're going to live, or maybe they may need a little extra down the future, option one would be the way to go. But most income riders that I see on annuities are the GLWB, which is the Guaranteed Lifetime Withdrawal Benefit. Now what this rider does, it allows the annuitant withdraw up to a guaranteed percent of the benefit base for life. That percent that they can withdraw is going to depend on how old they are when they take that first withdrawal. And we're going to look at that in a minute here, how it kind of works a little bit. Also, once again, it's a withdrawal benefit. You are not annuitizing the annuity when you have this rider on the annuity. So with the income riders, you have two account values. You have your actual account value. That's your cash. That's your real money in the annuity. You also have that benefit base, what I call the funny money. So for Nan, her account value is $968,000, almost $969,000, and her benefit base is $982,000. There are two numbers on the statement. They do two totally different things. So Nan, she has her income rider, and these riders guarantee a certain amount of growth. Now, clients, this is what most clients remember about the annuities. They remember, I'm guaranteed 5%, 6%, 7%, heck, even some do 10%. Typically, anything over 5% is going to grow compound. Anything under 5%. Anything over 5% is going to grow simple interest as a rule of thumb. There may be like a 6% compound growth on an older annuity, but if you see anything 7, 8, 9, 10%, it's going to be simple interest growth. So Nan, on her annuity, is guaranteed 5% growth. Now that 5% growth is not on account value, it is on her benefit base. So Nan, at the end of 2013, her account value grew to $814,000. Her benefit base is guaranteed to grow at 5%, so it grew to $691,000. So that's simply her $612,000 growing by 5% equals $691,000. Remember I said earlier there's a step-up feature on these annuities. What that does is that on a policy anniversary, for Nan's case, some annuities do it daily, some do it monthly, some do it quarterly. Most of them do it annual. So for Nan, on her policy anniversary, the annuity does a check. It goes, is the account value greater than the benefit base? In Nan's case here, it is. So what it does is that benefit base is going to step up to equal the account value. So now at the end of 2013, her account value and benefit base are both the same. 2014 comes along. Annuity has another great year. We all know the stock market's been doing good. Her account value is growing to $933,000. Her benefit base grew by the 5%, grew to 854. Account value is greater than benefit base, so she has another step up happen. So at the end of year 2014, account value and benefit base are both equal again at $933,000. Year 15 comes along. Account value grew to $968,000. Her benefit base grew to $982 based on the 5% growth. And this year, there was no step up because the benefit base was greater than the account value. So Nan is sitting here and she's looking at the values of her annuity. Her account value is $968,000. Benefit base is $982,000. She's thinking, wow, I got $982,000. It would sure be nice to live on the beach. Maybe I could take my $982,000 and I could go buy a condo on the beach. No, sorry, Nan, you cannot do that. That $982,000 is only used to calculate her income. It is nothing more, nothing less than a number on the statement that is used to calculate income. So in Nan's case, she is 70 years old, and as I said, your percent you can withdraw is based on the age of your first withdrawal. So this is the emeritus annuity, and this is how they calculate their withdrawal percentages. If Nan was only 50, she could withdraw 3.5%. But Nan is 70, so she can withdraw 5.5%. So for Nan, in year 3, her account value is $968,000. Benefit base is $982,000. She gets 5% of that $982,000, so she can withdraw $54,043 a year out of that annuity. So Nan sits there and thinks, well, I really want that condo still. I can get my income, so maybe I'll take some of my cash value and I'll go buy that condo with that. You can't have both. This is kind of when clients have these annuities with these riders, it's an either or. If you're going to use that annuity for income, then you're going to use it for income off that benefit base. If you take more than what you're allowed out, which you absolutely have the right to do, it's going to affect the annuity. And we're going to look at that in a moment here. But first, let's go back and let's look at Ann. So she's able to take out $54,000 a year. So we're starting here in year 4. She's going to take out $54,000 a year. Here's her account value. We're going to assume no more growth on the annuity on it just to keep the numbers simple. But what I want you to focus on is down here in year 21 of the annuity. She would have withdrawn all of the money out of the annuity. But if you notice, year 22 plus, she continues to receive the income. This is why you have these annuities with these income riders. This should be the goal of every single client who has one of these annuities, is to withdraw enough money out of the annuity under the rules allowed by that rider to hopefully deplete all the money out of that annuity. Because it's only at this point in year 21 that the insurance company is now on the hook to continue to provide income to Nan. That is why she paid that fee for that income rider all those years for this moment right here, where the insurance company has to continue to pay her that income even though there's no account value left in that annuity. And you'll notice her benefit base does not change. It stays at $982,600 because she never took out more than $54,043 out of that annuity. Even Michael Kitces has written an article about this, explaining this, that this is the goal of clients who have these annuities, is to get to this point. So in reality, any client who has one of these annuities, yes, it looks great if you wait a couple of years to take income. Maybe your income's going to be a little bit higher. But one thing is, just because you wait a couple of years to start taking income doesn't mean you're going to live a couple of years more because you decided to wait to take income. when you have these riders, your clients should be taking income as soon as they are eligible to start taking income out of them. You want to increase the chances that they're going to deplete the value of those annuities to zero. So now with Nan, what if she decides she wants to withdraw more out of this annuity than what she's allowed? Okay. So Ann, we have her account value is $968,000. Her benefit base is $982,000. She really wants that condo on the beach. So she goes, you know what? I'm going to withdraw half the money out and I'm going to go buy that condo. Nan can absolutely do that. It is her money in that annuity. She can withdraw it. So she withdraws $484,470 out of the annuity. But one thing to remember is when you take a excess withdrawal out of that annuity, it reduces the benefit-based proportional. So in this case, she's withdrawing 50% of the account value, so her benefit base decreases 50% also. It is not dollar for dollar. It is proportional. So now, Nan, we go back to our chart here in year 4, instead of withdrawing $54,000 in year 4, she didn't do that. She withdrew $484,000. And as we see, her benefit base got reduced. Because that got reduced, so does her income. Gets reduced now to $27,000. Went from $54,000 down to $27,000. And that will continue just as if that's where the annuity started originally. And we get to year 22. She's used up all the cash value in the annuity, but yet it continues to provide her income. Once again, that is the goal with these income riders on these annuities. So who should purchase a guaranteed income annuity? It should be clients who want guaranteed income. If they don't want guaranteed income, or if they're not going to use the annuity for income and they have an annuity like this, well, then they are definitely in the wrong product. They shouldn't be in it. They have old annuities or life insurance that they no longer need or they want to turn into income. So if they got an old annuity, they want to turn it into income, but maybe they still want access to that cash value. Well, you can move it to an annuity with an income rider. You still have access to that cash value, and they have that guaranteed income. Or if they have a life insurance policy that they no longer need, that's a cash value policy, you can move it over to one of these annuities and do it all tax-free. They don't have time to recover if the market falls. Like in Nan's case, we were able to move that money into the annuity, and immediately her floor on that income rider is the amount of money that went in that annuity. That market could go down 50%, but her floor on that rider is going to stay where it's at. In fact, it's going to grow by 5% every year. They want to lock in a gain. That was kind of Nan's case. We wanted to lock in that gain on that annuity, and they want insurance on an equity position. That's what those riders really are. You're buying insurance on an equity position. You're buying insurance that if the market goes down, that account value goes down, you got that rider there that's providing that insurance that's going to give you income based on a much higher value than what the value of that annuity is. All right, looks like I may have a question here. Make it so I can actually read it. Income rider benefit base assumes this includes the policy value of $968. Okay, so the question is, oh, no need to answer. Client, they understood. But let me just go over and make sure everybody else understood it. So the question was, the income rider benefit base assumes this includes the policy value of $968. They're two separate things within the annuity. They're two totally separate values. The account value and the rider value are two totally separate things. I think that answers that question. So let's move on. Fixed deferred annuities. So why purchase a fixed deferred annuity? Well, the most common reason I have advisors coming to me looking to see if this is an option for their clients is their clients are older and they're tired of the volatility of the market. because the fixed deferred annuity is going to give you a guaranteed interest rate. Another reason, as your clients get older and they get conservative, we can lock in gains and take them out of the market and move them into a product that's going to give them a guaranteed interest rate. They want a guaranteed rate. You know, maybe clients have money in CDs. Annuities typically pay more than what CDs do for the same rate. So if you have clients that are sitting in CDs, it'd be something to consider looking at. And it's a guaranteed inheritance. You can take money, say $100,000, put it into the annuity, name the beneficiary, the child or whoever you want it to go to, and it's guaranteed. That fixed deferred annuities cannot lose money. They're going to grow by that guaranteed interest rate and will pay out to that beneficiary if the client should pass away. So here's Janet. She's a client of an advisor, and the advisor came to me, and this Janet had two annuities. One was worth $325,000, another was worth $102,000. So Janet, you know, like so many clients, she didn't want to be in the market anymore. She wanted something more stable. So she was looking for a fixed rate. So what we did for Janet is we actually did an annuity ladder for her. So the first one we did, we purchased a 6-year annuity. We took $90,000 of that money, and this was a couple of years ago. Interest rates were higher than what they are now, but we were able to get her a 6-year rate that paid 4.25%. Then we did 2 7-year annuities for $112,000 each that paid 4.6%, and then we did a final 8-year annuity for $112,000 that was paying 5.1% at that time. So very simply, we created an annuity ladder, just like how you would create a bond ladder for a client. One thing to remember when you have annuities, if they're non-qualified annuities, once that money's in an annuity, it's kind of always in an annuity. When you take withdrawals out of an annuity, they're taxed as ordinary income tax, and if the client's under 59.5, they have a 10% IRS penalty also. Janet was under 59.5. She didn't want to pay taxes on her 2 annuities that she had. So that was another reason why we looked at using these fixed deferred annuities to do this annuity ladder for her. I'm always asked what our current interest rate's at. And here they are. You can see we get a 3-year at 1.85, and we go all the way out to 10 years, we could do 3.05. As you can see, the sweet spot right now is, you know, if you got somebody considering 4 or 5 years, going to 5 years, you're getting 2.5%. You're getting a nice bump there between the 4, or even going out to 6 years. Now you get a question like, well, why would anybody buy a 10-year rate annuity right now where interest rates are so low? So let me give you an example of what we just did. In fact, we're still working on getting the last couple of annuities issued for this client. Advisor came to me, client had over $1 million in a variety of annuities. Client was 78 years old. In the annuities he was in, when he hit 90, he had to start taking money out of them, and he didn't want that. Working with the advisor saying, well, you know, let's just, that 5-year rate, that looks good, let's just do that. And I pointed out to him, if we do a 5-year rate, client's 78, so he's 88. When he's 93 is when those rates are going to come due. The problem with that is you cannot purchase an annuity over the age of 90. So the goal of what we were doing with these annuities is they wanted to leave them to each other. It was a husband and wife. They each had annuities. So first beneficiary was going to be each other. But then they wanted to leave it to two charities that they supported. So we went with a 10-year annuity so we can guarantee that rate of 3.05 for the 10 years. If you go with a shorter rate, you're going to have to, at the end of that rate, go with whatever the renewal rate the insurance company is going to offer. So with this case, for that older client, it made sense to go with the longer rate to lock in that 3.05% for them to get it. So don't always discount some of the longer rates with annuities. There are certain cases where you have, in this example, older clients where it might make sense to look at those longer rates, knowing that when they come up to renew again, they may be too old to renew at new rates. All right, so I got some other questions that have come in. Let me see. Oops. Let me see what we got here. Sorry. Okay, so if a client wants to lock in gain, why do they typically buy during a recession or market correction? That is a great question, because it's the fear of it. You know, it's no secret. Clients, if they're left on their own, are going to buy high and sell low. It's the same thing. A lot of these annuities that are sold, and I mean sold, are sold out of fear to clients. You know, right now, market's been doing so good. If you see any of the trade publications, the sales of these annuities with riders have been going down because the market's been doing good. Once we start seeing a correction, my guess is we're going to start seeing an increase in the sales again. I got another question here. Can you only get income riders on variable annuities? No, they are also available on equity index annuities, and in fact, that would be the only reason I would ever recommend or consider an equity index annuity if you were purchasing it for an income rider on it. All right, are these rates based? Okay, so I think we're talking about the fixed annuities here. Are these rates before or after expenses? Fixed deferred annuities do not have expenses like you would see on variable annuities. Variable annuities is the only annuity that has expenses like that. With fixed deferred annuities, immediate annuities, the insurance company is going to cover their cost between what they're earning and what they're crediting inside the annuity products. Okay, I got a question. Fixed deferred annuity, if you start annuitizing and then die, do you get the remaining account value? We'll cover that when we go over immediate annuities. All right, I believe that is all the questions for now. All right, so interest rates. As Claudia had stated, I have been in the insurance industry for 20 years. And all as I have ever heard since I've been in the insurance industry is that interest rates are low, they're going to be going up. And in fact, as we can tell from this chart, it was in 1985, 1986, somewhere around there where interest rates peaked. And as we see from this chart, they have been going down ever since until last year we started seeing some movement going up. So I have heard that basically my whole career since I've been in the insurance industry is that interest rates are low, they're going to go up. Why lock in anything? In fact, I heard this from my own parents 5 years ago when I wanted to lock them into longer interest rates, and they decided to listen to the high school graduate from Schwab and didn't listen to me, and it cost them several $1,000s of interest on their money. But needless to say, we do see interest rates going up here. So this is where I'm going to get on my soapbox. So as I've said, all I've heard my whole career is that interest rates are low. Why buy? They're going to go up. So interest rates are starting to go up. So if I was there in front of you, I'd ask you all, what do you think I'm hearing today? Well, what I'm hearing today is that, well, interest rates are low. They're going up. Why buy anything fixed now? So the moral of the story is that if we knew exactly what interest rates were going to do, none of us would be doing the careers we have chosen now, we would all have nice cushy jobs on Wall Street if we were able to predict interest rates, making a heck of a lot more money than what we're doing now, because we would have the crystal ball that would tell us what interest rates are doing. If your clients have a need for a fixed rate at this particular moment, then now's the right time to buy it. Maybe not put it all in, maybe do a ladder like we saw with Janet, or if we're looking at immediate annuities, you could do ladders with immediate annuities also. But if your clients are in the need of a fixed rate, then now is the time to do it. All right, I'm going to get off my soapbox now. All right. I think I got some other questions here. So what is the benefit of a ladder of deferred annuities? It allows you to, just like a bond ladder, it allows you to spread out the periods of the interest rates so that as renewals come due, you're renewing at staggering interest rates again. So like now, those annuities that we were looking at for Janet, they are starting to come due now. So instead of all that money coming due and her having to lock into interest rates where they are all today, they're going to be staggered over the next few years, and she's going to be able to lock in, hopefully at higher interest rates than if she had to do it all today. All right, let's talk about immediate annuities. I'm not going to hold back. This is my favorite type of annuity that's available. So here we have Doris. Doris is the mother of an advisor. So the advisor came to me and said, my mother needs some income. What should I look at for my mom? So I went through a series of questions with this advisor. I said, does she want guaranteed income? He said, yes, she could definitely use some guaranteed income. I asked, does she have any old annuities or life insurance that she no longer needs? No, she didn't have anything like that. Does she need income in the next 12 months? She did. She actually wanted the income to start right away. Did she want to lock in any gains? She did have some investments that had done fairly nicely thanks to her son's help. So they were looking to lock in some gains and turn that into income. And I asked him, does she tend to be conservative? He said at this point in her life, yes. She doesn't feel as comfortable being in the market, even though I'm managing it for her. She still wants to take on some less risk. Great. So immediate annuity, that's the best product for her. It's going to give her the highest guaranteed income out of any product out there. So he asked me, so how much guaranteed income should we look at purchasing? I'm a believer in cover fixed expenses. You have the mortgage. Make sure that mortgage or rent's paid for. Make sure the utilities are paid for. Groceries. Everybody's got to eat. You want to make sure there's money coming in to provide that. And insurance premiums. You know, a lot of people laugh with this. I kind of chuckle myself. But if your clients have, say, a long-term care policy, or they got to pay their supplemental insurance, you want to make sure the money's coming in to pay for that, to pay those insurance premiums. Now, the reason I talk about cover the fixed expenses is you want to make sure these are taken care of, but use the rest of their portfolio to give them a quality of life. Use that as their fun. Use that for them to go take their trips. Do everything else. But you know that you got enough guaranteed income coming in. And that's not just from immediate annuities. You know, if they got a pension, if they got Social Security coming in, you know, you just use the annuities to supplement to get them to that level so their costs are covered. So which payout option should I select? Was his next question. Well, with immediate annuities, you got several different payout options. You got purity certain and life-only payout options. Purity certain, as the name says, is for a set period of time. It could be anywhere from 5 years to 30 years out in the future. Let's use a 10-year period certain as an example. Client buys an annuity with a 10-year period certain. They die after 8 years. that annuity will continue to make payments to a beneficiary for the next 2 years, fulfilling that period certain. The annuity is guaranteed to pay 10 years regardless of how long that client lives. Now, we're going to touch on period certains again later on when we talk about inherited annuities, because there is a very specific situation where they come in handy. But what most people, when they think of immediate annuities, they think of lifetime payouts. The payout option that's going to give you the greatest income is a life-only payment. The reason it gives you the most, because once that client passes away, payments stop. There's no guarantee of any type on it. Now, for some clients, that's great. If they don't have kids, or they're not worried about leaving anything to the kids, or maybe they don't have a lot of money and they need to maximize that income, then that life-only payout is the best option for them. We have guarantees, life with a period certain. Let's use an example, life and 10-year period certain. These payment options are going to guarantee to pay for the life of the client or that period certain, whichever is longer. So the client has a life and 10-year period certain. They die after 8 years. The annuity will continue to make payments to the beneficiary for the next 2 years and then stop. It fulfills the period certain part. Clients receiving payments, they die 8 or 10 years in 1 day, the annuity stops. It's exceeded the 10-year period certain, or if the client lives to 110, it's going to keep making payments to 110. My two favorite payout options are life with installment refund and life with cash refund. These two options guarantee that what was paid in is going to be paid out to the client or to a beneficiary. So let's say the client puts $100,000 into the immediate annuity, they're receiving payments, and they pass away after receiving $80,000. The installment refund option is going to continue to make payments to the beneficiary until that other $20,000 has been paid out, whereas the cash refund option is just going to write a check for $20,000 to that beneficiary. If the client passes away and they've received $100,001, the payments are going to stop. The refund option's been fulfilled, or it will continue to pay as long as they live. You can also do all these payment options with a life and joint and survivor option. So you can add a spouse. It doesn't have to be a spouse. It could be a same-sex couple. It could be pretty much anybody you want to add on. You can split the payments over the two. And you can even split it up that once one of them passes away, you can have the payment reduced to the survivor as an option. So we talked about these options for the advisor's mother. And Doris, she's age 75. She decided she wanted to put $250,000 into the annuity, and these were the payouts that were available at the time. As you can see, life only has the highest. Life and 10-year certain is a little bit less. Life with installment refund is a little bit lower yet. I'm often asked, what is the interest rate on immediate annuities? I wish I could tell you. I don't know. For those of you who have known me for a while, I came from the home office of an insurance company, was responsible for marketing immediate annuities, and even then I had no idea what the interest rate they were crediting on the inside of the immediate annuities when I was there. But I can tell you what the rate of return at life expectancy is going to be, and here's where they are for these annuities. So for Doris, she decided the life and 10-year period certain was the best option for her. So we also talked about, well, what about adding inflation onto the annuity? Well, there's two inflation options to add on an annuity. You have an increasing payout option, and you have one that's indexed to CPI-U. The increasing payout option could be anywhere from 1 to 5%. 3% is the most common. That payment's going to grow compounded by that inflation rate as long as the annuity is making payments. The CPI-U is not very common at all. In fact, there may only be one, maybe two companies that even offer it anymore. And your increases are indexed not to CPI, but to CPI-U. The U is an urban index, so it's even a little bit lower than what CPI is. So for Doris, we looked at what these payments are going to be. When you add inflation on, your payment starts a little bit lower. So we can see here her annual amount she was going to receive was $23,000. With inflation, it's $19,000. We got to go out 9 years before that inflation option has caught up to where that level payment has been. So for those first 9 years, we're at age 84. We're almost getting close to her life expectancy. She's lived with less income than if she had just selected the level. But that's not the end of the analysis when you're comparing inflation options. You got to look at what is the total amount paid out of the annuity. And when we look at year 9, the inflation options only paid out $193,000 compared to $214,000 on the level. We got to go out to year 16, age 91. Just so everybody knows, for a female age 75, life expectancy, according to an insurance company with an immediate annuity, not IRS life expectancy. Insurance companies assume anybody buying an immediate annuity is going to be healthy. They assume someone, a female age 75, is going to live about another 15 years. So as you can see here, it takes 16 years for our inflation-adjusted annuity to exceed the cumulative payouts that they would have received on the level, and we're 1 year beyond life expectancy. So to the insurance company, they really don't care whether a client takes inflation or no inflation. They're just modifying the payment stream to adjust so that at life expectancy, both annuities are basically paying out the same. Now, if you have a client and they have longevity in their family, it may be a time to look at inflation. But as I said before, you want to use this annuity just to kind of focus on their fixed expenses they have, use the rest of the portfolio to manage for fun and to hedge against inflation for that client. Normally don't recommend inflation on immediate annuities unless a client's got to put in a large portion of their assets to get the income where they need. And just so everybody knows, the maximum amount you can put into an immediate annuity is 50% of a client's investable assets. So for Doris, you know, a question I always get, should we buy the annuity now or should we wait a couple of years when the client's older to get a higher payout? So let's take a look at Doris. How much do rates have to increase to break even? So we brought the premium down a little bit, down to $100,000 just to make math simple. So age 75, her payment would be $8,759. If she waited to age 80, the payment would be $10,389. So it's going to be $1,630 higher annually for her. Not bad. But what a lot of people fail to do is they fail to look at how much income has been lost by not taking the payments right now at age 75. Well, she would have missed out on almost $44,000 over those 5 years by waiting to age 80 to take her income. And in fact, her break-even point is age 106, way beyond life expectancy. So if you ever are thinking about or have a client that says they want to wait to take income just because they're going to be older, the payments are going to be higher, it's a terrible idea. They're never going to make up for the lost income. But the question here is, how much do rates have to go up to break even? We're in an increasing interest rate environment now. We kind of believe we are, at least the Fed's telling us that. What I've been told by the actuaries and insurance company is that for a $100,000 premium, a 10% shift in the yield curve will change the payout $60 a year, and that can be up or down. So in this case, at age 85, her interest to break even at age 85, her interest rates would have gone up at age 80 to purchase that annuity by 1.8%. over those 5 years. Will interest rates do that? I don't know. I don't have a crystal ball that's going to tell me. I am a big believer in that when you need income, the right time to buy it is at that time and not to wait to see what interest rates are going to do or wait for a year, because chances are you're not going to make up the difference by waiting to start that income. All right, I know I have some questions out here. I got 2 more things to cover and I've only got 10 minutes left, so I'm going to have to keep moving forward with the PowerPoint here. So QLAC. So what is a QLAC? Well, it's a qualified longevity annuity contract. It's a cross between a deferred annuity and an immediate annuity. It can be purchased only with qualified funds, so that's money that has not previously been taxed. You can use it to supplement retirement solutions because with these annuities, income starts later in life, and it's a guaranteed payment stream. So when you buy these today, you know what that payment stream is going to be in the future. So with QLACs, it has to be a single premium. You can put in up to 25% of a client's qualified assets up to a maximum of $125,000. So the IRS is what's made QLACs possible, but they put limits on what you can and can't do with them. So you can put up to 25% of a client's qualified assets up to a maximum of $125,000, and you cannot use any Roth IRA money in them. You get guaranteed income stream from 2 to 30 years in the future, so you can defer those payments 2 to 30 years, but payments have to start by age 85, and that's what most people do is they start those payments at age 85. You have 2 payment options, life only and life and cash refund. That's it. You have a death benefit option on it, which means that if the client dies before payments begin, beneficiaries can receive the premium back. Of course, there's a fee for that. Your payments will be lower if you select that option. Or with the cash refund option, you have a death benefit once payments start that if they die before they receive the original premium back, beneficiaries will get the difference back. And this is probably the #1 reason why clients are purchasing QLACs. It's for the tax benefits. The money that goes into a QLAC is excluded from RMD calculations. Let me say that again. The money that goes into QLACs is excluded from RMD calculations. So let's take a look here. We have Steve who is 70 and a half. He has $500,000. And he must start taking RMDs on that full amount. Under these new rules from the IRS, he can take $125,000 of that, of his $500,000 in the IRA, and put it towards a QLAC. Now, his RMDs are based on $375,000. We've just reduced them. So if you have clients who receiving Social Security, they have pensions, they don't need any more income in retirement. Boy, we all hope we have that problem when we're in retirement, that we don't need any more income. But they're 70 and a half, and now they have to start taking money out of their retirement accounts, which means they got to pay more taxes. For those clients, this is a great option for them to help defer those RMDs or reduce those RMDs they have to take. So just to give you an idea what the payments are, we have with a death benefit, we get starting at age 85 is $4,000 a month. Without the death benefit, $5,653. You get a big bump when you don't have that death benefit on there. Single life with cash refund, it only comes with a death benefit. And you'll notice that the payouts aren't that much different. The reason being, it's actually 2 different companies. I used whoever had the highest payouts when I put this together. A lot of times there should be more of a difference in these payouts, but it just so happened when I ran this, it's not like that. And this company with the cash refund didn't have as high as a life-only payout. But it gives you an idea of where payouts are on these annuities. So inherited annuities. So here we have Jane. She inherited an annuity from her mother. It had a large gain in it. Advisors wanted to know what are her options. Well, she's got a couple of options. She can take a lump sum payment. She has to pay taxes on the gain. Even if the annuity has a death benefit, anything over cost basis is taxable as ordinary income. Once she has it, she can do whatever she wants with the money. She can annuitize over her lifetime. Therefore, she'll spread those gains out over her lifetime. She can stretch the payments over 5 years. So she can take that annuity, not do anything with it for 5 years, and then take it all out in 5 years, or she can take withdrawals out over those 5 years, however she wants. But just got to remember with annuities, gains come out first. Or we call it our super secret option because insurance companies don't tell you about this one. You can annuitize it over 5 years and spread those gains out over 5 years. How do you annuitize it? You do that 5-year period certain. So option one, she takes a lump sum. The annuity value was $260,000. $129,000 of it was her cost basis, which meant $130,000 she had to pay ordinary income taxes on. She does that, she can do whatever she wants with the rest of the money. She can annuitize over her lifetime. So for the first 25 years, her payments, or I should say her payments are going to be $15,393, but for the first 25 years, her non-taxable amount is going to be $5,172, and the taxable amount is going to be $10,221. The non-taxable amount is that cost basis being returned to her. In that 26 year, she only has $115 of cost basis left. Once the cost basis is returned, all of it is taxable to her. So you'll see in years 27 plus, all $15,000 of that payment will be taxable to her. Option three, she can stretch those payments over 5 years. So she'll receive $52,000 a year. In year one, it's going to be 100% taxable because it's all gains. Year two, once again, it's all taxable to her. Year three, only $25,000 taxable. The $26,000 is not taxable, and years 4 and 5 would be tax-free because that's going to be all cost basis. Why anybody would continue to do this after the 3rd year, I don't know why. Most people would just take the rest of the money out because all of it's going to be return of cost basis anyways. But for clients in this situation, that's not very favorable. You're taking $52,000 out year 1 and 2, and it's all taxable to you. If the client wants to stretch these payments out over 5 years, we have a better option, our super secret option that we call a super secret annuitizing over 5 years. What this does is you do a transfer to a 5-year period certain annuity. Those payments for her are going to be $53,741 each year. $25,903 is going to be return of cost basis each year, and $27,838 is the taxable amount each year, spread out over the 5 years. So for Jane, she had these 4 options. She didn't like any of the first 3. She decided to go with option number 4 and annuitize it over 5 years because she was able to spread those gains out. But a warning to everybody, we just had this with an advisor. The client made their selection before they talked to their advisor. Once you make your selection with an inherited annuity, you cannot change it. It is an irrevocable decision once it has been made. So we covered income riders, fixed deferred annuities, immediate annuities, QLACs, and inherited annuities. Click tooth. Top 10 things that make us different. One is we do these free monthly webinars. There is not one in July. We'll start it up again in August with what are low load policies and what they can do for you. As you know, we are not your competition. We do a lot of things to save your clients money. We do, especially with the pre-underwriting. We are proud sponsors of a lot of the fee-only groups and organizations. We have specialists for the different product lines. I am your annuity and hybrid specialist. For those of you who have worked with us, you know exactly what that AIM system is. It keeps you in the loop when clients are in the underwriting process. And stay tuned for our official launch coming up soon of our LLIS system. It is going to be a new way to do business with us to get us documents securely. You're going to have your own portal where you're going to be able to go in and see what's going on with your clients, and your clients will also have a portal to see where they are with everything. So that's everything I have. It is 5 o'clock on the nose. I will answer some of the questions now. Thank you everybody for staying. And if you want to hear what these questions are and the answers, please stay on. Let me see where you're. Okay, so what, I talked about that. Okay, here we go. Is there usually a minimum amount in a fixed deferred annuity? Yes, fixed deferred annuities, the ones we use typically have a minimum amount of $20,000 to put in them. Okay, I have a client with 3 non-qualified annuities with low basis. Are these good candidates for an irrevocable trust if we are trying to qualify for Medicaid, or does this create complications? I cannot answer that question. My advice is to go talk to an elder attorney. They would be the best ones to answer that question. Why don't I mention a 1035 non-qualified, non-spousal stretch option, taking RMDs based on her life? That is an option if the insurance company is going to offer that with the annuity. It all depends. And normally that is on qualified annuities. The one I was talking about was a non-qualified annuity. So your RMDs stretches are for qualified, and sometimes that's based on whether or not the insurance company will allow it, meaning can their systems handling it. So if you have an income rider on a variable annuity and die after a few years after starting withdrawals, do you still get the remaining account value at death? Yes. Whatever that remaining account value in the annuity is will be passed on to your beneficiaries. If you have an income rider and die after, oh, that's the same question. How do we get the slides? Claudia can send them to you. Someone's asking about annuities as a hybrid option. Yes, Andrew, you can call me tomorrow. I can talk to you about those, but I'm sure we'll be covering them in a webinar later on this year. All right, that is everything I have. Thank you, everybody, for listening in today. If you have any other questions, give me a call. My email address is there. You can email me. I see no other questions. Everybody have a great evening. Bye.